Okay, then we'll start with the new chapter now. Okay, how many heads of income are there? 5 heads of income are there. Okay, 4 we have already completed: salary, house property, PGBP, and capital gains. Okay, now the last head of income, the name of that head is income from other sources. Income from other sources. See how many sections we are supposed to do. Section 56, 57, 58 and 59. Along with them, we are supposed to do one more section, section 145. Okay. Now these sections are done. Then consider your other sources head is over. Very easy head, but very important also. Okay. Don't put this head in option. Don't give this head stepmotherly treatment, because this head can go with any particular head of income. So the income from this head can be asked with income of any head. Yes or no? So don't take this head lightly. Very easy, but important also. Okay. Now pay attention. Section 56 is the first section of this head. And as we all know, the first section of any head is charging section. Okay. So this section will tell you that which all incomes are taxable under the head IFOS. What sources of income will be classified here, and which income will be taxable. Okay. Then section 57 talks about deductions. Out of the incomes which are getting taxable under the head IFOS, what deductions you can claim? That is given in section 57. 58 talks about disallowances. While calculating the income under the head IFOS, what are the things which will be disallowed? And 59 talks about deemed income under the head IFOS. Deemed income. And section 145 is there, which talks about method of accounting, which I have already explained while doing PGBP head, if you remember. Okay. So these sections are to be done. But you won't believe that these sections you already know. These sections you already know. You have done PGBP, no? So the deductions which you claim while calculating your PGBP income, exactly same deductions you can claim while calculating your IFOS income also. 57 over. The disallowances which you consider under the head PGBP are exactly same applicable here also. But the disallowance will be made as per section 58. The section reference will be 58 only. Deemed PGBP income you have done. So 59 is similar to that. And section 145, which told you to calculate your PGBP income on mercantile basis, if regularly mercantile system of accounting was followed. Yes or no? Or you can calculate your PGBP income on cash basis if regularly cash system of accounting is followed. That same concept is applicable here also. Calculate your IFOS head on mercantile basis or cash basis based on the method of accounting regularly followed by you. Will you remember this? So basically, we are supposed to focus on this section. We are supposed to identify that which sources of income will fall under this head, and from that source what income will be taxable here. Yes or no? That is given in section 56. So I have sent you the notes also of section 50 of IFRS head. Okay, yesterday also I have sent you the notes of set of carry forward and exempt incomes. Okay, so that same notes I am going to open now and we'll start with this chapter. Okay, pay attention now. See, I was talking about this only. Section 56, 57, 58 and 59, and then section 145. Okay, I have explained this. What is there in each section I have already explained. Now coming to the first section 56. See, just like your PGBP and capital gains, there were two types of charge. One was general charge, another one was specific charge, right? There are two types of charge here also under the head IFRS. There is one general charge which is given in 56.1, and there is one specific charge which is given in 56.2. So as per section 56.2, there are certain incomes. The list of those incomes are given. Yes or no? So in this list, whatever incomes are given in this list, specifically these incomes will be taxable only under the head IFRS. These incomes will not go to any other head. These incomes will come in your IFRS head only. Specific charge. And now coming to the general charge says that if you are earning any income, what did I say? If you are earning any income and that income is not exempt under the provisions of Income Tax Act. So you are earning any income. First of all, the receipt should be your income. And that income is not exempt under the provisions of Income Tax Act, meaning that income is taxable. But you cannot classify that income under any of the earlier four heads of income. Yes or no? You cannot classify that income under salary. You tried to classify that under house property also. You tried to classify under capital gain or PGBP also. But you could not classify that income under any of the earlier four heads of income. So don't worry. Bring that income to this head and charge that income under this head, under the head IFRS. This is dustbin. This head is a dustbin. Put all your incomes in this head only, which you could not classify under any of the earlier four heads. So these incomes are going to be taxed, which cannot be taxed under any of the four heads, earlier four heads. Yes or no? But apart from these incomes, there are certain specific incomes which you are supposed to classify under this head only. So one by one, we are going to discuss these incomes only. Once the discussion of section 56 will be over, no? Understand this chapter is also over. Because section 57 talks about deductions. The deductions are exactly same which you can claim under the head PGBP. 58 talks about disallowances. Disallowances are exactly same which you can claim under the head, which are not allowed under the PGBP head. And 59 talks about deemed income. It is similar to section 41. So I don't have to worry much about those sections. If you know PGBP head, if you have learned PGBP head properly, you are going to be very comfortable with the deductions and disallowances over here. And even for deemed incomes. Okay. So one by one we are going to start discussing the incomes. Now which incomes I will start discussing, I will start discussing the specific charge. So once that list is done, I will give you few examples of general charge incomes also. Because see, I cannot give you an exhaustive list of all the incomes which are taxable under the head IFRS because of general charge. Because that list can be endless. There can be n number of incomes which can be taxed under the head IFRS because of general charge. We can at the most identify few incomes out of that Getting my point? And take few examples of those incomes. But we cannot say that only these incomes will be taxable as per general charge. Apart from these incomes, other incomes can also be taxed. Getting my point? What I'm trying to tell you? So pay attention. When I'll be discussing the incomes of specific charge, no, that time with specific charge also, with a specific income also, I will keep on covering few incomes which are similar type, but because of general charge they are getting taxable here. For example, if I talk about interest, there is a specific charge on interest income, yes or no? So along with the specific charge which is there on the interest income, I will talk about those interest also which are going to be taxed under the head IFOS only, but not because of specific charge, because of general charge. Rental income is there. Sometimes the rental income, specific charge on rental income is also there. So I'll be discussing the rental income under the specific charge. But along with that, I'll be discussing those rental income also which are getting taxable under the head IFOS because of, general charge. So with specific charge, few incomes from general charge, I'm automatically will be covered. Okay, no? But few more will remain. That we will discuss once we finish with the specific charge. Okay, so one by one, let's start discussing the incomes which are taxable under the head IFOS. Now see, I can give you the list that okay, this income there, this income is there, this income is there. Whenever you see this income, charge under the head IFOS. But while charging that income under the head IFOS, you have to be very cautious. You have to keep certain important points in your mind. So whatever incomes which we are going to discuss now is what? Taxable only. But while taxing those incomes under the head IFOS, we are supposed to be a little bit careful. We are supposed to remember some important points which I am going to discuss with that particular income itself. Okay. So first of all, what I'll do, first of all, see 56 subsection 2. Okay. This is a specific charge. In this, there are different clauses. Clause 1 is there, clause 1B is there, clause 1C is there. Yes or no? 1B is there, 1C is there, 1D is there, then clause 2 will come. But with 1D, I will discuss clause number 8 here only. Okay, then I will discuss about clause 2 also, then clause 3 also, clause 4 also, then 5 is not there, 6 is not there, 7 is not there. Directly we'll go to 8, but 8 we have already covered. Then we are going to come to clause number 9, then we are going to come to clause number 10, then there is one clause number 11, and there is one clause number 12. Now these 12 clauses are there. This last clause is inserted in the last Finance Act. Last year only the last clause is inserted. Prior to that, this clause number 12 was not there. This income was not getting taxed under the head IFOS. But from last year onwards, this income is also getting taxed. So now what we will do, one by one, we'll cover all these incomes. So first income, which is given in 56 subsection 2 clause 1, that income, my dear friends, is your dividend income. So we'll discuss dividend income first. Then the second income is winnings income, meaning the income from casual activities, the activities which involve chances of winning and chances of losing. So when there is win or lose in any activity, that is known as casual activity. So when you lose money, there is a loss. But when you win, you gain something, there is some income. That income is known as winnings income. Okay. Then 1C is amount deducted from employee's salary as his contribution to staff welfare funds or schemes. And don't worry, this income you have already covered in PGBP. While doing a deduction, 36 subsection 1 clause 5A, that time only this income you have covered there. I'll tell you, you will recollect, don't worry, okay? Then 1D is interest. Interest on securities. If not taxable under the head PGBP, then that interest will come here. Okay. Next one is interest on compensation or enhanced compensation on compulsory acquisition of any capital asset under any law. Okay, this we have seen in capital gains, but we have not seen interest over there. The interest we'll see here. Okay, then clause 2 talks about rent of plant, machinery, furniture. If that rent is not taxable under the head PGBP, then that rent will come under the head IFOS. Then there is one more clause. First of all, I am giving you the list, simple list I am giving you. Okay. Then one by one we are going to discuss all these incomes. Clause 3 talks about composite rent. Of building along with plant, machinery, furniture. Building let out along with plant, machinery, furniture, and both the lettings are inseparable. Then what you will do? You will charge that composite rent also under this head, but charge it only if it is not taxable under the head PGBP. Only if it is not taxable under the head PGBP. Yes or no? Then clause number 4 will come. That will talk about any sum received or receivable under the Keyman insurance policy. Even that sum will be taxable under the head IFOS. If not taxable under the head income from salary or PGPP. Next one is advance money. You call it token money. Received and forfeited. Advance money received and forfeited. Received for transfer. Received for transfer of capital asset and forfeited as transfer could not take place. Okay, this is on or after 1/4/2014, and if you remember, we have already covered this with section 51 under capital gains. Clause 10, very important, talks about gifts. Clause 11 talks about compensation or any other payment. Or any other payment on modification or termination of employment contract if not taxable under the head income from salary, then it will be taxable here. Okay, and 12th is maturity proceeds of a life insurance policy which is not exempt under section 1010D. So the maturity proceeds which is coming from a life insurance policy, if that maturity proceeds is not exempt under section 1010D, then that maturity proceeds will be taxable under the head IFRS. Now we are going to cover now this particular income along with clause 4 only. We are going to cover with clause 4 only, because all the insurance discussion we are going to do with clause 4. We are supposed to cover these incomes. See, these are the specific charge. This list is given. So whenever you see any of these incomes, request you to kindly tax these incomes under the head IFOS only. These incomes cannot go to any other head. Will you remember this? So this list only which we are talking about. So one by one we are covering that incomes given in those and in that list, and along with that some incomes of general charge will also be covered in between, and in the end I'll give you a few more examples of those incomes which are taxable under the head IFOS because of general charge. Okay, ready? See, the way in which you are going to learn IFOS with me, nobody else will be learning. Trust me on this. This will be the most exhaustive lecture on your income from other sources. Okay? So I'll try to cover as many things as I can. But remember, you have to, you have to take this head very seriously. Don't put anything in option. Sure? So first income which you can see, 56 of section 2 clause 1, that is dividend. That is what? Dividend. Now please wait. Before discussing the dividend, what is the meaning of dividend? Come on, tell. Dividend means whenever company earns profits, the company distributes these profits to the shareholder. Right, no? On that, the company is already paying tax. Sir, your doubt. Company is already paying tax on that profits. So out of that tax paid profits, the company is giving what? Dividend to the shareholder. So since the company has paid tax on this income, any distribution out of this to the shareholder, see, basically it should not be taxed. But if that is done, nobody will start their proprietary concern. Nobody will start doing business by way of what? Partnership firm. Everyone will go for, investing their money in what? Companies. Simple thing. Even if the company has paid tax on that income, out of the tax paid income only, the company is giving you what? The dividend. Understand one thing. Whatever income you are giving me may also be the tax paid income of your father, no? So can I go and tell the government, see, whatever income I am getting as a fees from my students, no? That is out of the tax paid income of my students' parents. So if the students' parents have already paid tax on that income, that is tax paid income, out of that I am getting my income, so I will not pay the tax on my income. It is wrong to say this, no? See, whenever you talk about any income, somebody is paying and somebody is receiving. So if that person who is paying the income would have already paid the tax on the amount, and out of that tax paid amount only, if he is distributing, if he is giving something to you, you cannot go and tell the government that government, I am getting something which is already paid, which is already taxed in the hands of others. That you do for partnership firm. That you do for HUFs. Because see, whenever a partnership firm will be there, that partnership firm will earn what? Profits. Okay. The profits are then distributed to partners. So out of this profits only, the partner is going to get his share of profit. Yes or no? Now on this profits, no, which is already taxed, in the hands of partnership firm. Out of this tax paid profits, if the firm is giving you something as your share, okay, that the government does not want to charge. So this share of profit received by the partner will be what? Will be fully exempt income under section 10(2)(a) in the hands of partner. It will be fully exempt. So for partner it will be fully exempt, because that is out of the income which is already taxed in the hands of partnership firm. And see, they are so closely connected to each other, no? They are one and the same only. There is no bifurcation of management and ownership here. The owners are only managing everything. Hello? So there is no bifurcation of ownership and management, but just for the sake of simplicity, the tax calculations, the firms are given the different status under the Income Tax Act. Getting my point? As compared to the individual partners. So individual partners are given different status. They are different person, and partnership firm is given different status. But in reality, if you will see, they are one and the same only. Because they are themselves managing everything. There is no bifurcation of ownership and management, which happens in the case of company. Getting my point? So hence it is not taxable in the hands of shareholder. Whatever share of profit not taxable in the hands of the partner. Whatever share of profit which the partner will be receiving out of the profits of the firm, that will be fully exempt in the hands of partner. Now that same logic you can apply. If you talk about HUF. So can I say even one HUF is also a separate person in the eyes of law? HUF will earn profits. From that profits, HUF on those profits, HUF will pay tax. And out of those profits, whatever share of profit which is given to the member of that HUF, that should not be taxed in the hands of the member. That share of profit will be fully exempt under section 10(2). Getting my point? 10(2). So share of profit of the partner exempt under 10(2)(a), and share of profit of member will be exempt under 10(2). There it is 10(2)(a), it is 10(2). Okay. Logic remains the same. But this logic you cannot apply in the case of companies, which you were trying to apply. Kaushik, this logic you cannot apply. You are a shareholder, you have money. So you have invested that money in some company, and on that money you are getting the returns. So this is your return on your investment. How can we exempt that? If you would have invested that money somewhere else and you would have got the return, you would have paid tax, no? So why not now? Pay tax now. Here you are not investing money, you are doing a business on the name of HUF. Here you are not investing money, here you are doing a business on the name of partnership firm. Management and ownership are not separate. Management and ownership are not separate. One and the same only. Manager, who will be managing the entire HUF? Members only. Karta only. Yes or no? So they are the owners themselves and they are the managers also themselves. There is no segregation of management and ownership over here. But when you will talk about a company, the management is different. Okay, that is all together in its own way. It is a, legal entity. There is a separate existence as per some law. Management is different and ownership is different. Owners will give the money. Owners will invest the money. And on that money, they expect some return from the company. So whatever amount they have invested in the company, in the shares, on that shares, whatever returns they are getting, that is nothing but return on their investment. And return on any type of investment, including the investment in shares, in the form of dividend, will be treated as your income, which will be taxable for you. Earlier, it was taxed in the hands of the company. Company used to pay income tax, additional income tax on that under section 115(o) as a dividend distribution tax. And hence it was exempt in the hands of the shareholder because the company was already paying tax on that. So company was paying the tax on its own income. Along with that, whatever amount the company is going to distribute to the shareholders in the form of dividend, on that dividend distribution also, which is treated as income for the shareholder, it is the return on investment, it is treated as the income. The tax used to be taken from whom? It was taken from the company only. 115(o) was there. Now few years back, no, they removed 1150. They said no. Now the company will not be liable to pay DDT. We don't want to charge tax on this income from the company in the form of DDT. Let the shareholder only pay. So it will be taxable in the hands of shareholder. So accordingly, the exemption which the shareholder used to get for their income, for their dividend income, that exemption was withdrawn. Why it was done, you know? Company was paying DDT at the rate of 20% only. The same logic which was there for buyback price, I told you. So if the company is paying 20% on entire dividend, for example, if some shareholder is going to receive 50 lakh rupees of dividend, on that entire 50 lakhs, the company used to pay only 20%, only 10 lakh rupees of tax to the government. Whereas if this dividend is taxed in the hands of the shareholder in the form of normal income, the shareholder can give more tax to us. On the first 10 lakh, he'll give only 1,12,500, nil plus 1 lakh, nil plus 12,500 plus 1 lakh. But any dividend over and about 10 lakh, on that he can give us 30%. Then why to settle for 20% if we can charge, we can get more tax from the shareholder? Hence 1150 was omitted, and the dividend got taxable in the hands of shareholder, even if it is coming out of the profits of the company on which the company would have paid tax. But you cannot apply this logic to that dividend. Getting my point? That is treated as a return on investment made by the shareholder in the company, and that return of investment we cannot exempt. We have to charge, because if we will exempt that return on investment, what the other people will say? See, we are also investing in the debentures of a company, and on that we are getting what? Interest. So interest amount the company is giving out of profits only, no? So we are also not going to pay tax on that. Everyone will start coming and giving this kind of logics to us. Getting my point? Understood, no? Convinced? So now the dividend is taxable. Now the dividend is taxable in the hands of shareholder. But what is dividend? What is dividend? Whenever a company is having profits, no, the distribution of this profits to the shareholder in cash is known as what? Dividend. Can be given in two ways. It can be given in the form of final dividend. It can be given in the form of interim dividend also. We have heard about final and interim dividend, no friends? What is final dividend? The dividend which is given, declared on every AGM, annual general meeting. So at every AGM, the company will declare some dividend. Once it is declared, it cannot be cancelled. Within 30 days of the AGM, it has to be given to the shareholder. So final dividend, once declared in AGM, cannot be cancelled. It has to be given to the shareholder within 30 days of the conclusion of AGM. Yes or no? Now, whenever between two AGMs, if the company decides to give more dividend, so that is decided in the board meetings held between two AGMs. So one AGM is held right now. Next AGM is about to come after a year. Now till that time, what if the company, what if the management, the board of directors wants to give more dividend to the shareholder? So they will have to wait till AGM. No, in the board meeting itself, they will decide, they will declare one more dividend. That dividend is known as interim dividend. Once it is declared, it is not necessary that it will be compulsorily received by you. No, it can be cancelled also. It may be cancelled also. So after declaration, it can get cancelled also. Yes or no? Now see, whatever final dividend you are getting, whatever interim dividend you are getting, that dividend, friends, that dividend is distribution of profits of the company in the form of cash. Company is having profits. Those profits, those reserves, the company is distributing you in the form of what? Cash. Is it necessary that profit will be distributed always in cash. What if the company distributes profits in kind? Don't you think that also should be treated as dividend? Because to avoid the tax liability, avoid the DDT, or avoid the tax liability by the shareholder, the company and the shareholder can resort to some ways in which the dividend could be given but will not be treated as a dividend. Why? Because if the profits are distributed in the form of cash, only then they will be treated as what? Dividend. But now see, we are distributing profits only, but the distribution is not made in cash, so it cannot be treated as dividend. Don't worry, to take care of all such things, they have come up with a concept of deemed dividends. These distributions, these payments might not appear to be dividends, but under the Income Tax Act, they are also treated as what? Dividend. It will be assumed, it will be deemed as if such payment, as if such distribution is what? Dividend in your hands. And accordingly, that will also be taxable under the head IFRS. So the term dividend, which we normally understand now, as per the accounting terminology, okay, that is a very narrow term. Under the Income Tax Act, the definition of the meaning of the dividend is very wide. It covers the interim dividend also, final dividend also, and there are certain other distributions and payments which are deemed as a dividend under the Income Tax Act. So not just the interim dividend, but the final dividend also. Not just the interim and final, but there are some other payments, there are some other type of distributions made by the company to the shareholder. Even those will be treated as dividend under the Income Tax Act. Because you can distribute, you can pay such things to the shareholder to avoid the tax liability on this dividend income. Understanding or not? So we are going to learn those deemed dividends one by one. Don't worry about that. Okay. One by one, I will explain each and every deemed dividend. And this year, there is one amendment also in the concept of deemed dividend. One new deemed dividend has been inserted, 222F. If you remember, we have done in 46A, buyback of the shares by a domestic company from the shareholder. Whatever buyback price given on or after 1st October 2024, even that buyback price will now be treated as deemed dividend, 222F. Earlier it was not taxable for shareholder, fully exempt under 1034A, because the company used to pay 115QA tax on that. Now with effect from 1st October 2024, the company is no more paying any tax, 115QA. Now the dividend will be taxable in the hands of the shareholder, meaning 1034A abolished, no exemption. Now the dividend will be taxable, but don't consider this dividend as your full value of consideration for transferring the shares under section 46A. Actually, this should be taxed under the head capital gains only, under section 46A, because this buyback price which you are receiving is for transferring your shares. But the government does not want to charge tax at the rate of 20%. Because if you will show that amount as your full value of consideration under the head capital gains, what will happen? Even you are going to pay tax at the rate of 20%. So what was bad in taking that 20% tax from the company itself? If you want to take 20% from you also, so it was better to take 20% from the company, no? So there will be no benefit by abolishing 115QA, omitting 115QA, charging this dividend in your hands. We want to charge this charge this buyback price in your hands. At what rate? At a rate which is higher than 20%, and which is possible only if this income, only if this buyback price is not taxed as your capital gain. It is taxed in your hands as normal income. Let us make this amount deemed dividend. Once it is dividend, it will be taxed at normal rates. We can charge 30% tax on this from the shareholder. But if this amount would have been considered as your full value of consideration for buyback of shares, yes or no, then it could have been taxed at the rate of maximum 20% under the head capital gains. Getting it or not? Everything has a logic. If you understand, then it is okay. Otherwise, it is magic. Sure. So now, one by one, we are going to discuss the deemed dividends. But before that, very important discussion. See, if I talk about a company, any company is there. Okay. And this is the shareholder. This is the shareholder. Now, can I say this company is earning income? Out of this income, out of the profits, the company will pay what? Dividends. Dividend to the shareholder. Now, that dividend which the shareholder is getting is, it can be any of the three dividends. It can be final dividend, it can be interim dividend, even it can be deemed dividend under section 222A to 222 clause F, newly inserted clause F. Yes or no? Now, whenever you are going to get the dividend, no, you are a shareholder. For shareholder, these dividends are taxable. Taxable under the head IFOS only. There is a specific charge. The charge says that this dividend will be taxable only and only under the head IFOS. This dividend cannot be taxed under any other head. In the hands of shareholder, it will be taxable under the head IFOS. Will you remember this? Okay, no? But this is not the end. Now tell me when it will be taxable. For the shareholder, when it will be taxable. What is the year of taxability? Depends on what type of dividend the shareholder is getting. For the purpose of taxability of the dividend, there is one section, and that section is section number 8. Section number 8. That section 8 talks about chargeability. Chargeability of what? Dividends. And this section 8 says that final dividend, interim dividend and deemed dividend under section 222 A to F. Yes or no? Final dividend will be taxable in which year? Interim dividend will be taxable, chargeable in which year? Deemed dividend will be chargeable in which year? For that, you are supposed to follow section number 8 only. Meaning that I told you one thing, that whenever you will calculate the income under the head IFRS or PGBP, you will follow the method of accounting. Meaning that regularly method of accounting followed is mercantile basis. So all the incomes will be taxable on mercantile basis. This year's income will be taxable in this year. Hello. This year's expenses will be allowed as deduction in this year. Whether received in this year or receivable. Whether paid in this year or payable. You are following mercantile basis, regularly maintaining the books on mercantile basis. So all the incomes, all the expenses will be considered on mercantile basis. This year's income you take, this year's expenses you take, whether you have received or it is receivable, whether you have paid or it is payable. For PGBP also and for IFRS also you are supposed to do the same thing. Wait. If you are following cash basis of accounting, then regularly maintaining your books on cash basis, then your PGBP as well as IFOS will also be calculated on cash basis. Meaning, this year whatever income received will be taxable in this year. May or may not be for this year, but if it is received in this year, taxable in this year. This year whatever expenses actually paid may or may not be for this year, maybe for other years also, but actually paid in this year will be allowed in this year. So your PGBP or IFOS will be calculated on what basis? Cash basis. Whenever you calculate PGBP, whenever you calculate IFOS, you are supposed to follow 145. You are supposed to follow method of accounting. All the incomes taxable on mercantile basis, all the incomes taxable on cash basis. If mercantile basis is followed, cash basis is followed, as the case may be. Yes or no? But wait, there are 3 exceptions. What did I say? 3 exceptions. And dividend is the first exception. Never ever apply method of accounting for the purpose of chargeability of dividend under the head IFOS. Dividend will always be charged under the head IFOS based on section number 8. Hello sir. Whatever section 8 will say, according to that only the dividend will be charged. So section 8 says that if you are talking about final dividend, so final dividend will be taxable. Final dividend will be taxable as income in the previous year. Which previous year? In which declared. Because once it is declared, it is confirmed that you are going to get it now. So even if you charge on what basis? Declared basis, then there is no problem. You are going to receive it. So don't worry, charge it on declared basis. Whenever you will receive, at that time, don't again consider as your income, because you have already considered on declaration basis. Yes or no? So taxable as income in the previous year in which it is what? Declared. It is declared. Okay. So will you apply method of accounting over here? Section 8 specifically says that the year in which it is declared, it will be treated as income for that year only. It will be taxable in that year only. Now don't follow method of accounting. We don't want to see. See this year, AGM was held. In the AGM, the dividend for last year as well as this year, both the dividend got declared in this year. And you were following mercantile basis. So can you say that the dividend which got declared in this year for the last year, I will not pay tax on that because I am following mercantile system of accounting? I will charge only that dividend which is declared for this year. Hello? I am following mercantile basis. That does not mean that the dividend for this year only will be taxable. If final dividend is declared for this year as well as for the last year, if it is declared in this year, will be taxable in this year. No need to see method of accounting. Hello sir. Will you remember? If you are following cash basis, you charge the dividend only if it is received. Because you are following cash basis. No, I charge all the incomes under the head IFOS only if it is received. See, this year this dividend is not received. It is only declared. So whenever I will receive, that time only I will charge. No, you cannot do it. The moment your final dividend is declared in this year, even if you are following cash basis, even if you have not received it in this year, still it will be taxable in this year. Because this is the year in which it is declared. Got it, sir? Now, what about the interim dividend? Come on, tell me. Is it necessary that once it is declared, it will be paid to you? Or it can get cancelled also? So this should not be taxed on declaration basis, because if it is declared, if it is taxed on declaration basis, what if it is later on cancelled by the company? So unnecessarily we'll charge tax from the shareholder, and the shareholder will have to come to us for claiming the refund. of tax which he has already paid on the dividend which he has not received only, which is cancelled. Getting my point? So that should not happen. So let us charge tax on this interim dividend in the year in which it is made available to the shareholder, unconditionally made available to the shareholder, meaning received by the shareholder. Hello? So it will be taxable as your income in the previous year in which it is received. Received means unconditionally made available to the shareholder. Received means unconditionally made available to the shareholder. Yes or no, sir? Will you remember this? Now this will be taxable as income in the previous year in which it is distributed or paid as the case may be. So the year in which it is distributed or it is paid, because some deemed dividend are distributions. Some distributions are treated as deemed dividend. Some payments are treated as deemed dividend. So those payments which are treated as deemed dividend will be taxable for you in the year in which they are actually paid. Some distributions are treated as your deemed dividend. Hello? So will be taxable in the year in which they are actually distributed. Hello, sir? Will you remember this? Sure, everyone, sure. Very good. Will you follow method of accounting? Or charge the dividend as per section 8 only? See, you know that the dividend is taxable here. There is nothing new. Everyone will know. Just like you, all the CA students will be knowing that dividend is taxable under the head IFRS. But why you are different from other CA students? Because they only know that the dividend is taxable here, but they don't know. It is taxable on what basis? Section 8. So while charging the dividend under the head IFRS, please take care of this. Getting my point? Charge the dividend like this. And this they actually ask in the exam. Now there will be some doubt also. See, few doubts which I must clarify right now. Okay. What if the dividend is on shares which are listed? That dividend will be taxable here only. What if the dividend is coming on the shares which are unlisted? Even that dividend will be taxable here only. What if the shares are of a public limited company? What if the shares are of private limited company? Will not make any difference. Shares are of a company or even a cooperative society. Will not make any difference. No. Even you are holding the shares of any company, whether public limited or a private limited, or you are holding the shares of a cooperative society also. On those shares, if you are getting the dividend, no, please charge that dividend under the head IFRS only. Yes or no? Can your shares be equity shares? Yes, sir. Can your shares be preference shares? Yes. Will it make any difference? No. Even the equity shares dividend will be taxable here only. Even the preference shares dividend will be taxable here only. Getting my point? Can the shares be of an Indian company? Yes. Can the shares be of a foreign company? Yes. Will it make any difference? No. But wait, if the dividend is coming from the shares of an Indian company accrued in India, So no matter wherever it is received will always be taxable for you because it is your Indian income. Where it is taxable? Under the head IFRS. Whatever may be your residential status, ROR, RNOR, NR, it will always be taxable for you. If it is received by you outside India, then also taxable. Because in that case, it will be deemed to accrue or arise in India. Section number 9, if you remember. Now, what if the shares are of a foreign company? But the dividend of that shares you are receiving in India, then it becomes Indian income, irrespective of your residential status, ROR, RNOR, NR, it will be taxable in India. Hello, sir. But what if the shares are of a foreign company, meaning dividend accruing outside India, and the dividend is also received outside India? In that case, it will be your foreign income. Part A or Part B? Part B foreign income. Tick, cross, cross. Will be taxable only if you are ROR. But where it will be taxable? Under the head IFRS. Getting my point, everyone? Shares can be listed. It can be unlisted. Shares can be equity. Shares can be preference. Shares can be of an Indian company. Shares can be of a foreign company. Shares can be equity or preference also. Shares of an Indian company, anything. If shares are there, even the shares of a cooperative society you are having, on those shares, whatever dividend you are receiving, that will be taxable here under the head IFRS. Now, sometimes the shares are held as what? Stock in trade, or even they can be held as capital asset. Will not make any difference. And please don't even dare to charge the dividend on the shares held as stock in trade. Don't even dare to charge this dividend under the head PGBP. The dividend will come here only under the head IFRS. Even if the shares are held by you as stock in trade, will not make any difference. The dividend on those shares will come here only. Even if the shares are held by you as capital asset, the dividend on those shares will come here only, because there is a specific charge. Getting my point? All these things must be kept in mind. This thing must be kept in mind, and this also must be kept in mind. Now tell me, if I say that dividend will be taxable always under the head IFRS. This case also, this case also, this case also, this case also, and this case also. Right, sir? Now, if you will show this taxable under the head IFRS, deduction for any expense incurred to earn such dividend income will be allowed or will not be allowed? Not be allowed. Meaning that the entire dividend will be taxable. Will you remember? Entire dividend will be taxed without giving any deduction for any expense which you might have incurred to earn this dividend income. But wait. However, deduction can be taken. Deduction can be taken for interest on loan which was taken to acquire what? Shares. So the loan which you have taken to acquire the shares, on that loan whatever interest you will give, no, that interest we are ready to give you as a deduction. But other than that, any other expense we are not going to allow. Will you remember this? Sure, sir. But wait. the interest on loan taken to acquire can be taken as a deduction. Yes or no? Can be taken as a deduction to the extent of maximum 20% of dividend income. So if the interest paid by you is, for example, 50,000, you have taken a loan to invest in the shares. Hello? To invest in the shares, you have taken a loan. On this loan, you are paying interest. Will that interest be allowed as a deduction out of the dividend on such shares? Yes. But wait, the interest paid by you was 50,000 and the dividend income was 1 lakh. Can you claim 50,000 out of 1 lakh? The answer is no. The interest will be allowed to the extent of maximum 20% of your dividend income. So how much was your dividend income? 1 lakh. 20% of that, 20,000. So any interest up to 20,000 you can claim. But interest over and above 20,000 will be ignored, will not be allowed. To the extent of 20, it can be taken as a deduction from your dividend income. Will you remember this? Sure, sir. But any other expense you cannot claim as a deduction. Sure, sir. Now tell me one thing. Tell me, this dividend, after taking this deduction, will be shown under the head IFOS. Will be shown under the head IFOS. So once the dividend will be taxable under the head IFOS, and from this the amount will be taken as a deduction. Meaning, after claiming this deduction, the balance amount of dividend will be taxable as your IFOS. So have you shown some dividend taxable as IFOS in your, have you shown some dividend taxable as income under the head IFOS? Now that IFOS will be taken as a part of your GTI, no? So will your GTI include IFOS? Yes. In that IFOS, have you included this dividend? Yes. Don't separate it. Chapter 6 said deductions are available from this dividend. Don't worry. Chapter 6 said deductions are not available from which incomes? STCG 111A, LTCG 112, LTCG 112A and winnings income. From these incomes, chapter 6 said deductions are not available. So there is no restriction. Dividend will be taxable under the head IFOS. This is your normal income only. No special rates is prescribed. Meaning that this dividend which you are charging under the head IFOS will be taxable at what rate? Special rate? No, it will be taxable at a normal rate only. Just like other normal incomes like salary income, house property income, PGBP income, just like these incomes which are taxable at normal rates under the head IFOS, this dividend income is also taxable at normal. All the IFOS incomes are taxable at normal rates only. Hello, including the dividend. But winnings, when you will charge under the head IFOS, no, winnings will not be taxable at normal rates. You will have to separate it. We are going to see that also. So what I am telling you, whenever you will bring any income under the head IFOS, all the incomes are taxable at normal rates only, including dividend. So after taking the taxable amount of dividend minus the deduction for interest, whatever amount of dividend remains, that is a normal income only. You have to show this as a part of your GTI. Now out of GTI, when you reduce those incomes, LTCG, STCG, because you cannot claim chapter 6 and deductions out of them, don't reduce the dividend. Dividend is just like your normal income. From other normal incomes, are you able to claim chapter 6A deduction? Yes. From here also you can claim chapter 6A deduction. Will you remember this? Now wait, one more thing. Higher rate of surcharge, 25% and 37%, is not applicable on 4 taxes. Tax on LTCG 112, tax on LTCG 112A, tax on STCG 111A, and tax on dividend, which you will calculate at normal rates along with the other tax. Yes or no? So tax on your balanced total income calculated at normal rates. On that tax, out of that tax, whatever tax which you have calculated on dividend income, no, on that tax, higher rate of surcharge 25% or 37% is not applicable. Maximum surcharge rate is 15%. Can you take the tax on dividend as a rebate? The answer is yes. Rebate is not allowed only for one tax. Hello? Which tax? LTCG 112A. That tax cannot be claimed as rebate. All the other tax, including the tax on dividend, can be claimed as rebate. Sure, sir? Everyone? And at what rate the dividend will be taxable? Normal rates. So pay attention. Dividend taxable at normal rates, number 1. Number 2, chapter 6A, deductions, ATC to ATU, available? Yes, available. Then higher rate of surcharge, at the rate of 25% or 37%. Applicable, not applicable, not applicable. And not applicable on tax on dividend income. Yes or no? Rebate of tax on dividend income can be claimed? Yes. Tax on dividend income can be claimed as rebate. Just like other taxes can be claimed, this tax can also be claimed as rebate. Yes or no? So this was your dividend. That's it. Wait. There is more discussion remaining. Have you understood so far whatever discussion we have made? This entire discussion. Okay, now from here we started. Now, final dividend, I need not tell you what is final dividend. Because we know AGM to AGM declared, taxed on the basis of declaration as per section 8. Hello? Taxed on the basis of declaration. Interim dividend, also your IFRS income, declared between two AGMs, can be cancelled also, hence taxable on what? Receipt basis. But now, apart from final and interim, you have deemed dividends also, no friends? So what are these deemed dividends? Which type of payments, which type of distributions are covered from clause A to clause F, which will be treated as deemed dividend? Now one by one we are going to discuss them. Okay, no? So once that discussion is over, the discussion of dividend will be over, because all the other discussion we have already completed, no? Okay. Now one small thing I'll tell you, one small thing I like to connect over here. See, whenever you get dividend, no? So the company paying the dividend to you, okay, that company, okay, this is, wait. If there is a company paying what? Dividend to the shareholder, if it is a domestic company paying dividend to shareholder can be any person, shareholder can be individual, shareholder can be HUF, shareholder can be firm, shareholder can be any other company also, yes or no? But that shareholder must be a resident. So whatever this domestic company is paying as dividend, yes or no, if that dividend paid during the previous year, paid during the previous year, aggregate amount coming from this company to you. Getting my point? So I am talking about aggregate total amount of dividend coming from this company to you during the previous year as what? Dividend. So that aggregate amount, if it is more than 5,000, on this entire aggregate amount, TDS is deducted under section 194. TDS is deducted. When deducted, how much deducted, I'll tell you in TDS provisions. The rate and all we are going to see there, okay? No? So don't bother yourself about the rates right now. It is 10%, okay? 10% TDS will be deducted. So the domestic company paying the dividend to the resident shareholder, and the aggregate amount of dividend paid by that domestic company to the shareholder, then that domestic company will be liable to deduct the TDS on the entire amount of dividend if that entire amount of dividend, if the aggregate amount of dividend paid by the company to the shareholder during the previous year is more than 5,000. That is a requirement of section 194. Getting my point? Now what the shareholder will have? See, the domestic company will pay the dividend. That dividend will be gross amount. Example 100. Out of that, TDS under section 194 will be deducted at the rate of 10%. So the net amount of 90 will be given to you as a dividend. Hello sir. Do you remember? Something like this we did in salaries chapter also. On your salary, section 192 says that the employer will deduct the TDS. After deducting TDS, you are given net salary. But how much salary you charge under the salary head? Net or gross? Do you remember? We have already completed salary head. Okay. So your salary is 1 lakh, employer is deducting 10,000 TDS. You are getting 90,000 only. But under the head salary, how much salary you show taxable? Gross or net? Entire gross 1 lakh you show taxable over there, no? Because out of that 1 lakh, 10,000 is going in the form of TDS, is application of income. The 10 which is going deducted at TDS and going to the government was your income only, deducted in the form of tax and given to the government. That 10 is your income, and the 90 which is also coming to you is also your income. So how much is your income? 1 lakh. Show that 1 lakh gross as your gross amount as your taxable salary. So under the salary head we always show gross salary as taxable, no? So apply the same logic here also, no? If the TDS is deducted by the company and the net amount of dividend is given, will you charge the net amount or you will charge the gross amount? You will charge the gross amount. Net plus TDS, gross amount you will charge under the head IFOS. Now friends, this dividend can be final also, this can be interim also, this can be 222, A2, 222F, any dividend paid by the domestic company, on that the company is required to deduct TDS. See, it is not said that only the total of final dividend you will do, only the total of interim dividend. No, during the previous year, whatever type of dividends are given, add all those dividends to this shareholder. Yes or no? A single shareholder getting all the dividends from this company. If the aggregate amount of dividend coming to you from the domestic company during the previous year is more than 5,000, in that aggregate count all the dividends coming from the company. Yes or no? Count the final dividend, count the interim dividend, count the 222A to 222F, all the dividends you are supposed to count. Now check this total total dividend which you have received during the previous year from the company. Immediately you will get a message from the company. The moment the company knows now that you are going to get more than 5,000, immediately you will get a mail from the company, message from the company. Please provide your permanent account number, PAN number, so that we can deduct the TDS on your PAN. If you don't give the PAN, no, the company will not deduct TDS at 10%. The rate will be 20%, 20 or 10, whichever is higher, 20% TDS will be deducted. But the requirement to deduct TDS will arise only if the total dividend during the year coming from that company exceeds 5,000. And that is given in section 194. Sir, what if the dividend is given to a non-resident shareholder? Will there be any TDS? Yes, there will be TDS, but not under 194. The provisions are different. That you are going to learn in final CA. Understanding? So now I am not going to discuss this 194 in TDS chapter. I'll tell you already done. This is 194. That's it. Getting my point? Still, I'll speak something about that. Okay? In TDS. You should not feel that sir has not taught this. Sir is teaching you everything. It is up to you how you remember it and how long you remember it. Just now I asked a simple doubt that under the head salary, how much will be taxed? Gross or net? You are like this only. This should be remembered. Hello? Will you? So under the head IFOS, for this, always the gross amount will be taxable. Always. So net is given in the question. That is 90%. Convert it into 100%. Cross multiply. You will get the amount of dividend. That dividend will be taxable. If nothing is mentioned in the question, no, consider that the dividend amount is gross only. But if they are telling you that this dividend is net, meaning that it is after TDS, 90%. Cross multiply. If 90% is this much, how much should be 100%? Can you cross multiply? Yes, you will get the gross amount. That gross amount you are supposed to charge. But wait. The tax deducted on dividend, TDS, under section 194. Later on when you will calculate your tax liability, no. From the tax liability, this TDS will be allowed as a credit. Reduce that much amount of TDS from your tax liability. But right now you will have to show it as your income. Because this is your income. Got it, sir? Should I move? So whatever discussion I have done no, so far. See, dividend has wider scope and meaning under the Income Tax Act. Why? Because under the Income Tax Act, final dividend, interim dividend are all dividend. But apart from that, certain specific distributions or payments by company to the shareholder also treated as dividend. Known as what? Deemed dividend. Defined under 222 A to F. Okay. When the dividend will be taxable? Chargeability of dividend as per section 8. Already discussed. Hello. Then some important points. Dividend coming from company other than domestic company, meaning a foreign company, accrued outside India. But what if received in India? Indian income. If it is Indian income, ROR, RNOR, NR, any of them, it will be taxable, even if it is from a foreign company. But what if the dividend from a foreign company accrued outside India, also received outside India? Come on. Then it is a foreign income. Part A, no, part B. Tick, cross. Taxable for you under the IFRS only if you are ROR. Not taxable if you are RNOR or NR. The shares of an Indian company, whenever the dividend will come, no. Forget about the residential status, ROR, RNOR, NR. Forget the fact that where that dividend is received will always be your Indian income. If received in India, then also Indian income. If received outside India, then deemed to accrue arise in India, then also Indian income. Understanding? This I have already discussed. Now, shares, equity preference, listed, unlisted, public limited, private limited, shares of a company or a cooperative society, whatever shares you are having on that, the dividend will be taxable here only. Even if the shares are held by you as stock in trade, still the dividend will be taxable as IFS and not PGBP. Even if the shares are held as your investment, as your capital asset, still the dividend will be taxable under the head IFS. Dividend taxable at what rate? Normal rates. Deduction, chapter 60 deduction will be allowed? Yes, will be allowed. Higher rate of surcharge will be applicable on the tax on dividend? No. Higher rate of surcharge, 25%, 37% not applicable on the tax which you have calculated on the dividend income. Yes or no? Can you take the dividend, can you take the tax on dividend as rebate under section 87A? Yes, you can take. Only one tax is not allowed to be taken as rebate. Yes or no? LTCG 1128 tax cannot be taken as rebate. Okay. Now next one. Along with the dividend on shares, the dividend on units of UTI and units of mutual fund. See, what happens now? There is one company. Okay. There is one company. Will this company have a capital? Will this company have a capital? So if you are a person investing in some part of the capital, so that part is given to you in the form of what? Shares. In the capital you are having this much share. Out of the 100 rupees of capital, you are having 20 shares. Hello. Out of the 100 shares, you are having 20 shares, meaning that out of the entire capital, 20% is invested by you. So to represent that 20%, you will be allotted the shares. Share is a share in the capital of a company. That is the definition of shares. What is share? Share is a share in the capital of the company. That is an evidence in your hands that you have invested, you have contributed in the capital of the company. Evidence you get. Share. Understanding? Earlier it used to be in physical form. Share certificate. Now you don't get it in physical form. Now you get it in dematerialized form. For those shares which are listed. Okay. But for other shares which are not listed, still you get the share certificate. Physical form. Hello sir. Got it? No? Now if there is a UTI or mutual fund, will it have capital? UTI or mutual fund will also have capital. Now in this capital, you are contributing in this capital. So will you have some share in this capital? So that share is not known as share, that share is known as unit. Because its capital is not known as share capital, its capital is known as unit capital. So in the unit capital, how many units you are holding? Meaning how many shares you are holding. It is as good as shares only. So earlier what used to happen? Earlier the dividend on shares was exempt in the hands of shareholder. Why? Because the company used to pay DDT. Just like that, the dividend on the units was also exempt under section 1035 because the UTI or mutual fund used to pay DDT on that dividend under section 115R. 115O taken away, 1034 taken away. So now the dividend on shares taxable for shareholder under the head IFS. Just like same, in that same manner, 115R omitted. Now the dividend distribution tax will not be paid by UTI or mutual fund. So now the dividend coming to the unit holders will also not exempt for them under 1035. Now that dividend on units will also be taxable under the head IFS only. It is as good as dividend on shares, but known as what? Dividend on units. Because the company where you have invested this amount, that company is a mutual fund company or UTI. Hello, they call their capital not as share capital, they call their capital as unit capital. In the unit capital, whatever share you are having, that share is known as what? Unit only. Same to same, everything which is applicable on the dividend on shares is applicable on dividend on units also. Will you get any deduction for any expense from the dividend income on shares? No. So you will not get it from dividend income of units also. Taxable at normal rates. Everything which we have discussed, no, for shares will be same. But wait, last point I'll tell you that for dividend, whatever loan you have taken to invest in the shares, on that loan, whatever interest you have paid, that interest you can claim up to maximum 20%. Same applies here also. Whatever amount you have taken as a loan to invest in the units, hello, on that, whatever interest you are paying, that interest will also be allowed as the dividend income from the units, but to the extent of maximum 20% of such dividend income. Will you remember? This entire thing I have already discussed. Okay. No deduction under section 57. Now the discussion about deemed dividend will happen, and this discussion we are going to do in tomorrow's lecture. Okay. So tomorrow's lecture, very important. We are going to start with deemed dividends. Okay. And we are going to complete the other incomes also, which are taxable under the head IFRS. Now dividend is almost, part of dividend is over. Now only the important discussion is deemed dividend, which we are supposed to do, and you are supposed to be very careful in this also. Okay. But very interesting, very logical. You'll enjoy it. So tomorrow we are going to meet. I'll text you the time. Okay. And tomorrow we'll continue from here. Okay. Bye bye everyone.